The US dollar has been uptrending since mid 2018, and there have been periods in recent days where the buck has looked like it's wanted to extend the run. But it hasn't been able to do so, with the euro very well supported on dips, the commodity currencies making impressive runs, and even the pound recovering quickly after dipping to that 27-month low the other day, showing discomfort with the prospect of deeper declines. Recent dollar demand has come from speculation the Fed may be less inclined to cut rates because of stronger economic data, but this hasn't been something stopping the Fed in the past, and the Fed chair has been very clear in communicating readiness to cut rates because of risks that extend beyond the data. Meanwhile, the U.S. administration continues to push its soft dollar trade policy initiative. President Trump was just out with more tariff warnings on China, and we think there is plenty more to come from this front that should make dollar upside far less attractive. Technically speaking, we think it's well worth considering the possibility that the euro and pound are actually in the early stages of developing uptrends. For the euro, this means the single currency is supported roughly around the 110 barrier for a higher low above the multi-year low from early 2017. And for the pound, this means a higher low around current levels above the plus 30-year post-E referendum low from 2016. On Wednesday, currencies managed to recover against the buck. The heavily watched euro got some help from an above-forecast inflation print. The pound was relieved to see its inflation data come in as expected, and the Canadian dollar got an additional boost on hotter Canada CPI. These inflation reads also follow above-forecast Kiwi inflation earlier this week. Inflation is definitely a metric to watch going forward, as central bankers have been able to justify keeping rates lower for longer because of a prolonged period of subdued inflation. And so when inflation does start pushing back up again, it will put central bankers in the uncomfortable position of needing to keep rates low, but also needing to weigh the what could be a more dangerous downside risk if they don't err on the side of less accommodative policy in an effort to stay ahead of inflation. This could be yet another downside risk for equity market investors going forward. Perhaps this latest minor sell-off is sensing some of this reality. That's all for now.